asset allocation decision and discuss just how critical this judgment is to the investor's ability to build wealth over time. We also will then see how asset allocation ties into the process of creating an investment policy statement, which represents a formal summary of the investment problem confronting the individual or the institution. You recall that what the asset allocation decision represents is really the first effort we have of deploying our capital. And so the idea is how much of our money are we going to invest in broad asset classes? And we have both traditional asset classes, such as public equities, common stocks, fixed income. Those could be traditional bonds. We know now that also includes asset-backed securities and other forms of fixed income securities, and then cash equivalents. Then we also have the alternative asset classes, which represent other types of investments that have a material difference in terms of their returns, their risks, their connectivity, their correlations, as we'll call it, with our more traditional asset classes. So what we saw as the strategic asset allocation decision that an investor makes is the first cut at trying to place their financial capital into the capital markets, which is, broadly speaking, how are you going to divide up your money into those different asset classes? We took a look at one very prominent investor. This was the University of Texas Endowment Fund. And we could see that indeed they have public equities, they have both investment grade and other non-investment grade fixed income, and they also have cash equivalents, but then they also have a lot of private market assets and what we call alternative assets. So their strategic allocation, their current allocation is here. And you can see relative to the strategy that they've adopted in the policy, whether they're underweight or overweight. So for instance, they have 32% of their money in public stocks, US, non-US, emerging markets, all throughout the world. And that represents an overweight relative to the strategic policy of 1.7%. And so that's the way we would interpret that chart. So as we move forward now, there are a couple things I want to underscore from, again, our last discussion and building for the future. We saw that the two ways we can think about investing strategically is to be either a passive investor or an active investor. And in some way, that's almost a philosophical decision on our part. The idea of a passive investment is simply going to be to match our strategic asset allocation targets. The goal here, again, is simply to figure out what combination of assets gives us the most effective form of taking risk in our portfolio, and then trying to operationalize our investing to generate just the expected returns that would be associated with those asset classes. That's sometimes referred to in the practice as the beta level of our investment. The distinction of beta from alpha, which again is where we're trying to actually outperform the market. So passive investing sometimes is more colloquially called indexed investing. We're simply we're not trying to beat the market or outperform the market. We're just trying to participate in the market at an appropriate level of risk that we're comfortable with. So active management then, as we've seen, has as its goal to capture everything we would have as a passive investor, plus some additional value added, which we call alpha, which represents our differences in opinion on some form from what the rest of the market thinks. So we talked already about two different ways to accomplish that: tactical asset allocation would be to change temporarily the asset class weights in our portfolio away from our strategic policy. And if we're right about what we either underweight or overweight, then we're going to beat our benchmark. So, for instance, going back to your Timco a second ago, they have a 1.7% overweight in public equities. So, if public equities perform exceptionally well, they will do better than their strategic asset allocation benchmark because they have more money invested in what turns out to be, in that example, a better asset class. The other way to generate alpha is through security selection. And so just to kind of home in a little bit more on this and bring together a couple of threads we've talked about, is we've seen that we can think of risk taking as being systematically related to broad market movements, or unsystematic or idiosyncratic. Unsystematic and idiosyncratic are synonyms in this case, which would represent company specific risk factors. And so when we do tactical asset allocation, market timing, that's really playing around with our systematic risk exposures. We're choosing to systematically overweight an asset class. Or by the way, we can do tactical asset allocation at a sector level. So within equity, we could say overweight value stocks relative to growth stocks, hoping that value as an investment equity style mounts a comeback over what we've seen over the last 10 years, based on our discussion in our last class. By contrast, security selection as a way to build alpha is an idiosyncratic risk-taking enterprise. In other words, you're making company-specific bets on which companies are going to outperform those that are represented in an index. So how important is any of this in terms of the wealth that an investor creates? There was a very important study that was done something in the neighborhood of 30, 35 years ago now by Gary Brinson, who is a money manager out of Chicago with Brinson Partners, now UBS Brinson Partners, and a couple of his colleagues. And they wanted to address the following question. If we take a look at the performance of a group of investors, and they looked at a group of 91 different pension funds, like a Texas teachers retirement system, we can see what sort of returns they actually produced. But the question they were asking is, of all of the things that investors do, what is it that produces the returns? What are the most important factors in terms of producing the returns? And so they compared the actual returns that this group of investors generated. And then they said, let's do a few different hypotheticals. Firstly, if they had just invested their money according to their strategic allocation in the benchmarks that were specified in their investment policy, what would their return have been? In other words, if they had just simply purely passively indexed their money with no attempt to try to produce alpha, what would the return have been? And then they also looked at two other hypotheticals. If they had generated their performance with their policy allocation, their strategic asset allocation, but also used their market timing talents, what would their returns have been? And then by contrast, if they looked at the strategic allocation with just their stock picking prowess involved, what would the return have been? So we know the actual return, and we're going to compare that actual to three different hypotheticals. So to get to, kind of a bottom line on the study, what they established was that this group of investors over a 10-year period generated an average annual return of about 9%. And that's actually not a bad return. When you work, if you end up working for a pension fund or even an endowment fund, you'll find out that most of the time they're looking for a return in the range of 7.5%, in order to support the payouts they have to make. So if they're earning 9, they're actually earning annually in their portfolio more than they need to pay the bills, so to speak. But here's the problem. What Brinson and his colleagues established is that if they had just followed a purely passive portfolio, in other words, if they invested according to their strategic allocation and invested just in the benchmark portfolios, they didn't try to outperform by tactically overweighting or underweighting asset classes, nor did they try to buy different stocks than were in the benchmarks. They would have generated a return of 10.11%. And so the alpha in this case is negative. So they had a negative alpha of 110 basis points, 1.1%, meaning that if they had just matched their benchmarks, they would have been over 1% per year better off than when they tried to beat the benchmark. So the first point of the study was that was kind of a stiff indictment against the management skills of that group of 91 pension fund managers. But what they really wanted to know is what mattered the most in terms of everything you do as an investor. What matters the most? And what they found, and we won't go through the process for doing it, but what they found was that 93, almost 94% of the variability in the returns that each of these pension funds produced was directly related by the initial strategic asset allocation decision. So much less mattered the stock picking abilities, much less mattered the market timing abilities. The biggest driver of wealth creation over time for an individual fund is going to be its initial strategic asset allocation decision. That is far and away the most important thing for any given investor to get right in terms of their analysis. And so I in the reading packet for this session, there was another article by Ibbotson and Kaplan, and they addressed the question in a slightly different way. And they argued that this so-called 90% rule, as some people have dubbed it, that 90% of the variability in investment performance comes from your initial strategic asset allocation decision. They said it really depends on how you ask the question. So that Ibbotson Kaplan article is kind of parachuting you into the middle of a debate that had been going on for quite some time. But let me give you a high-level summary of what they were trying to say with that. What we're looking at is a matrix of returns where we have, say, different pension funds or mutual funds or endowment funds, Fund A, Fund B, Fund C, and so on. And then we have the returns that they produce, let's say every quarter for a period of 40 years. So we have, 160 returns that we're going to analyze. We have two ways that we can look at performance. What Brinson and his colleagues did was to take what we call a time series perspective, meaning what they did was they looked at an individual fund, let's call it Fund J here, since that's what I just circled, and we looked at how the returns were produced by that fund over time. And when that is our question, the answer is absolutely unambiguous that it's the strategic asset allocation decision that matters the most. All right, so now what Ibbotson and Kaplan did was take a look at things from a slightly different perspective. And they said, what if the question we're trying to address is a cross-sectional question? So for any given, let's call it year instead of quarter, what will allow Fund A, that may be Duke University's endowment fund, what will allow them to earn a higher return than, say, UTIMCO or University of Texas's endowment fund? So the cross-sectional question is saying, at a moment in time, I may think of myself as competing against these other managers. What will allow me to outperform other funds at the same moment in time? And the answer is different. And here, security selection in particular, it's those alpha building talents that matter the most when the goal is to try to beat my competition in a given year. All right, so now the point I wanted to make with this discussion, I know this is getting a little bit, drilling down a layer here, is that we have a bit of a conflict of interest going on here. Clearly, investors are going to worry about the time series perspective. In other words, their best interest is for you as a manager to build their wealth over time. And that comes down to prudent strategic asset allocation decision making. But if I'm the manager at an endowment fund, my compensation is going to be paid in part, whether I get a bonus or not, is going to be paid in part based on whether I can beat other endowment funds trying to do the same thing I am. So managers often have this cross-sectional perspective where they're trying to do the things that will help them, quote unquote, win the game this period, not build wealth over time. That's a agency conflict, as we call it, a principal agent conflict that we'll come back to a couple times in the course, but I wanted to kind of home in on it now. And in fact, speaking of endowment funds, I did some research with a couple of co-authors that looked at the same kind of study that Ibbotson and Kaplan and Brinson had done, looking at endowment fund data relative to, instead of the pension fund data they did. And what we found was that endowment funds tend to be better investors. Their alpha over time on average was about 2/3% per year. But otherwise, we found more or less the same conclusion. The numbers were a little bit different, but the vast majority of the return variability that endowments produced was because of their strategic asset allocation decision. Much less important were those alpha building skills. More important, as it turned out, being a good stock picker and a good market timer than in pension funds, but still a very distant second to the importance of that main risk-taking decision in terms of the strategic asset allocation. So what is the right strategic asset allocation? Well, as we talked about a couple of times now, is that's going to depend on the nature of the investor. And so again, a mantra for us throughout the course, and certainly in terms of the group projects, the term project where you're going to be managing funds for two very different investors, is that the right solution has to be dictated by the nature of the problem that the investor represents. And so when we think about different investor types, we're really talking about the important distinction being that they have different problems that they're trying to solve. So they're going to need different solutions and different allocations as the solution to their problem. So at a broad level, we distinguish between institutional investors and individual investors. And there are a number of important distinctions here. The primary ones to me are that institutional investors tend to be more long-term focused. As we talked about earlier, Endowment funds don't really have a expiration date in the sense that the university will live, at least conceptually, forever, even though individuals don't. Individuals expire, they pass away. And so there's a shelf life to the individual investor that we need to take into account. The other thing to recognize is, for the most part, when we talk about investing for um, institutional investors, so this would be pension funds, endowment funds, insurance companies, and financial institutions of other kinds, often that is tax exempt investing. Whereas, at least in terms of their own personal savings, individual investors tend to be taxable. So the risk tolerance that it would be acceptable to an institutional investor, such as a endowment fund, is going to be quite a bit different than the risk tolerance for an individual investor. And so what I wanted to just kind of wrap up this part of the discussion for this recorded lecture is to talk about the way we try to summarize an investor's problem. And the way we do that is to create, whether this is done formally or less formally, we create what's sometimes referred to as an investment policy statement. And what that represents is a written statement that summarizes what we know to be true about our investor's problem, so that we can effect a solution in full knowledge of what it is, what problem we're trying to solve. So that's really the first step in our investment management process that we outlined last time, was to focus on what an investor's goals are. And in fact, we can really talk about the elements of an investment policy statement. And as an exercise in class, we'll go through and actually put together the outline of a policy statement. And then that's a big part also of the deliverable for the group project for the semester as well, for your two clients. We can start with the different objectives that an investor is trying to realize. The first is required rate of return. That's not just a number. It certainly starts there. For instance, as we talked about a second ago, pension funds need to generate a nominal return of somewhere in the neighborhood of about 7.5% each year in order to pay the retirement benefits that they're obligated to pay to their stakeholders. But it also, think of the required return not just as a number like 7.5%, but also we've seen now how that return is packaged. What portion comes in capital gain and what portion comes in cash flow. That's going to be, for individual investors in particular, that distinction is going to be very important. Secondly, then, in terms of what we think of as the objectives or the goals that define what an investor is faced with, it's what their risk tolerance is. That is usually, almost always, in fact, by far the most critical thing to assess properly. How much are they willing to, can they tolerate in terms of the riskiness of their investing? When we think about risk tolerance, let's always kind of think about two dimensions of that. There's a willingness, which is in some sense at a genetic level how they're wired in terms of their ability or willingness to take risk. But there's also the financial ability. And so somebody that has $10,000 as their sole savings in the world is going to be in a much different ability level to take risk than somebody with several million and income coming in from a job. So it's not just whether you feel willing to take on risk. It's your financial ability that dictates that. as well. Now, offsetting those objectives are a lot of restrictions or constraints that might be involved in the investment process as well that defines the problem for the investor. What their liquidity needs are. Now, let's be careful with the term liquidity. Where we're going to define liquidity is how rapidly an asset could be sold and converted back into cash at approximately its market value. And so we think of real estate, for instance, as a fairly illiquid asset because we'd have to get find a buyer for our house, go through escrow, and that could take at minimum, several weeks to a month to complete that transaction. Whereas checking accounts are considered to be all but cash equivalents from the beginning. So they're very liquid investments. So liquidity is going to matter more to some investors than other. That's going to be a big distinction in terms of how much we can invest in private market assets, like private equity versus common stock. One of the key distinctions there is private forms of equity investing are far less liquid. And so that's going to be tolerable to different types of investors. Time horizon, of course, whether we're in retirement already or whether we're 25 years old and we're not thinking about retirement for another 4 to 5 decades. Whether we're taxable or not, we talked about. Also, the legal structure that governs how our investments will be interpreted if something goes awry. Most institutions are governed under something along the lines of ERISA, which is federal law. We'll talk more about that as we go along. And then a lot of individual investors are interpreted under what we call the prudent person rules. But there's been increasingly less of a distinction between prudent person rules, which historically have been state law, and ERISA, which is a federal law. There's been a pretty good merger in terms of how those are interpreted. So this isn't as important a distinction as it used to be. Unique needs and preferences. Anything that an investor.
Yep. I bought a bunch of turkey yesterday. Oh, good. Okay. Yep. Love you.
Did you talk to that?
I left him a message. They didn't answer. So I'm waiting for the call back. Amit's in Wichita until Wednesday morning.
Probably can't, huh?
Okay. Love you.
Love you.
We try.
Does or doesn't want as a restriction. It's their money. So as a money manager, if you're trying to solve their problem and they say, we've had bad luck in our family with people who have smoked and passed away from cancer, and so I don't want any tobacco stocks in the portfolio. That's just simply a unique preference of an investor. At the endowment level, the state of Texas, for instance, mandates that we can't put into the UTIMCO portfolio any companies that do business in Iran. And so that would be another unique type of restriction. Those have to be taken into account as well. So in terms of assessing risk tolerance, since that's the most important thing, that's not just the most important thing, it's easily the hardest thing to do, primarily because we don't have particularly good definitions of risk. So we've seen, for instance, one of our measures of risk is a standard deviation, and that might be about 19.8% annually. So if you asked a potential client, hey, are you willing to accept risk level of 19.8 units on a standard deviation? They're not going to have any context whatsoever for what that means. And so you're very likely not to get a good discussion. So what we see done in practice mostly is that individual investors, particularly on risk tolerance, may be given a series of questions to try to get a broad sense of their not only financial ability, but also their willingness to tolerate risk. You know, the old saying, how well do you want to sleep at night, as a measure of how much risk you're willing to take. So a lot of institutions, money management firms working with individual clients, and these might be, you know, private wealth managers, may try to use a survey such as the one you're looking at here, to try to ascertain at a broad level, you know, whether the level of risk is either risk tolerance is either high or low. Now, however we come up with that risk tolerance level, it's a little bit more clear cut that a strategic asset allocation needs to align with that risk tolerance level. And so this is a chart that shows you for a few different leading financial institutions, Fidelity, Vanguard, and T. Rowe Price, how they kind of think about it. And the broad rule of thumb here is that any allocation that is tilted more toward equities is going to be considered risk. Remember, we saw in our early discussion, one of our fundamental facts about financial markets is that really it's going to be the ownership of assets, you know, equity investing, where the risk resides. So the higher the percentage of our asset allocation weights are tilted toward equity or equity-like investing, whatever the form, public, private, U.S., overseas, value growth, you know, whatever it is. If it's equity, it's going to be viewed as riskier than certainly cash equivalents or even fixed income. So some of these 60, 30, 10 stocks, bonds, and cash allocations that we've talked about would be appropriate for an investor who has the capacity to take on a higher level of risk, but also has an intermediate to a long time frame as an investor. So here's an example of an investment policy statement. And let me point out to you that at the end of chapter 2, one of the questions that I want to take time exploring in class, and we'll work through this one together, is question number 8 in chapter 2. And so if you would take a look at that in advance, and we'll have a chance to talk about that in class in detail, because what we really comes down to is that in any of these problems where we are given some of the background of an individual investor or an institution, and then we're typically asked to do two things. The first is to create a policy statement that summarizes the investment problem. And secondly, to choose a strategic allocation that is our best impression of how to solve that problem. So the policy statement is a formal statement of the investor's problem. And then the strategic asset allocation is the first and most important step in creating a portfolio solution to that financial problem. So here's, just to give you a sense of it, here's what an investment policy might look like. And this was actually a friend of mine who retired from a corporate job and put together a family foundation a few years ago. And so you can see that they specify objectives. This is interesting. Instead of saying we want 7.5%, they actually specified a somewhat more relative investment objective, where they want to spend 5% real each year, and they also want to keep pace with inflation. So instead of 7.5 as a static number, what they want is 5% plus inflation. So that 5% represents their real spending goal. And that's that's fairly common for most foundations and endowments and pension funds to have a real return spending goal of somewhere in the range of 4.5 to 5%. So that's what dictates this as well in this instance. And so then you can see that they've embedded their asset allocation. They have a 75% equity, 25% fixed, with some other designations of how much deviation a manager could take away from that 75-25 mix. So for instance, it's plus or minus 15. And these are what we sometimes refer to as the tactical range that's permissible. So this manager for this foundation, they're told that their long-term vision should be 75% of their money invested in equities, but they could have as little as 60%, minus 15, or as much as 90. So a lot of times you'll see these tactical ranges presented as a way of giving a little bit of constraint to the flexibility that a manager has to tactically deviate from the strategic allocation. Beyond that, you can see the different constraints that this investor faces in terms of time horizon, very long term. Again, the foundation, the whole idea of designing it is presumably to outlive the donor. Liquidity needs, they don't really have much in the way of liquidity needs. There's going to be a federal excise tax that they want to take into account, but other than that, it's not taxable. It's a trust under Texas law. Again, as I mentioned a second ago, state laws and federal laws are kind of merging in terms of the way you manage, and I'll talk more about that when we address those issues throughout the semester. And then in terms of the unique needs and preferences, you get a sense here of where this person worked for their career and amassed the wealth, because they work for ExxonMobil. Because one of their unique preferences is that this investment portfolio for the foundation always has to contain Exxon stock. You can never sell it. That's what they mean by an unmanaged position in Exxon. And so, does that make sense financially? Does that make sense in terms of the conceptual side of portfolio building? Yeah, I don't know, but the reality is it's this person's money, and that's what they want, and so that becomes a practical reality of the problem that you're trying to solve. So we'll look at again question 2.8 from the textbook in class as a way of kind of going through these two steps. We'll take the facts of somebody's life, which is what the problem presents, and then we'll sketch out a policy statement that would be appropriate way of summarizing the problem, and then we'll also take a look at putting together a strategic asset allocation that matches that. I'll also point out on the website there are some other examples of policy statements as well that you can take a look at if you want to dive deeper into this area for now.